Valuation ratios are important financial metrics that help investors evaluate the value of a company. In this video, we will discuss three important valuation ratios: price-to-book (P/B) ratio, price-to-sales (PS) ratio, and price/earnings-to-growth (P.E.G) ratio. We will explain what these ratios mean, how they are calculated, and why they are important for measuring business value and financial health. Price-to-book (P/B) ratio. The P/B ratio is a financial ratio that measures the price investors are willing to pay per dollar of book value. The book value is the value of a company's assets minus its liabilities, and is considered to be the net asset value of the company. The P/B ratio is calculated by dividing the current market price per share by the book value per share. A higher P/B ratio generally indicates that investors are willing to pay more for each dollar of book value, which may suggest that the company has strong asset quality or growth potential. However, a high P/B ratio may also indicate that the company is overvalued, and investors should be cautious before investing in such companies. Conversely, a low P/B ratio may indicate that the company is undervalued and could be a good investment opportunity. Price-to-sales (PS) ratio. The PS ratio is a financial ratio that measures the price investors are willing to pay per dollar of sales. The PS ratio is calculated by dividing the current market price per share by the revenue per share. A higher PS ratio generally indicates that investors are willing to pay more for each dollar of sales, which may suggest that the company has strong revenue growth prospects. The PS ratio is particularly useful for valuing companies that do not yet have positive earnings, as it focuses on the revenue generated by the company rather than its profits. However, a high PS ratio may also indicate that the company is overvalued, and investors should be cautious before investing in such companies. Price/earnings-to-growth (P.E.G) ratio. The P.E.G ratio is a financial ratio that takes into account a company's expected earnings growth rate. The P.E.G ratio is calculated by dividing the price-to-earnings (P/E) ratio by the earnings growth rate. A P.E.G ratio of 1 indicates that the company is fairly valued based on its earnings growth, while a P.E.G ratio below first of may suggest that the company is undervalued. The P.E.G ratio is particularly useful for evaluating growth stocks, as it provides a more complete picture of a company's valuation by factoring in its expected earnings growth rate. However, investors should be careful when interpreting the P.E.G ratio, as it is based on estimates of future earnings growth, which may not be accurate. Conclusion. Valuation ratios are key aspects of financial analysis that help investors evaluate the value of a company. By understanding key valuation ratios such as the P/B ratio, PS ratio, and P.E.G ratio, investors can gain a better understanding of a company's financial health and make better investment decisions. However, it is important to remember that valuation ratios are just one piece of the puzzle when it comes to evaluating a company's investment potential. Investors should also consider other factors such as the company's competitive advantage, management team, and market trends before making investment decisions. If you like our videos, then don't forget to like and subscribe our channel. Thanks for watching.